It seems like all the talk today, yesterday, and the days in between has been all about inflation, rates, et cetera. As an equity investor, equity manager here, do you worry at all about this elevation that we've seen so far?
I think the markets have already, equity markets have already priced in, obviously, a steepening of the yield curve. We, like the rest of the street, expect a 50 basis point hike tomorrow. For us, kind of bigger picture, what we're really worried about for our clients is the 60-40 portfolio and its future from here. Because
is 60-40, that's still a thing?
Yeah, well, it is, because most assets around the world, including a lot of people at this conference, are allocated against that portfolio. And just quickly, it returned 8% real compound return in the last cycle. That was incredible. And you could just follow that and do quite well. That number is 5% over the last 100 years. It's negative 8% year to date. And so, you know, a lot of clients are wondering, are we on the precipice of a lost decade for a balanced asset allocation?
Do you think you abandon the 40 side of that now, even though we're only, 4 or 5 months into the year?
I think actually equities can perform against an inflationary backdrop, so we would be overweight equities versus bonds, for example. There is a difficult setup in general for risk assets because while equities are down 13%, valuations are still at their 90th percentile most expensive. We have slowing growth and inflation picking up, so some people think stagflation's a real risk. And we know that we have the removal of the central bank put. In other words, we could depend when things were tough, like they are now, that we would get a rate cut and everything would be fine. That's no longer the case because we know the central bank needs to fight inflation. So it's a tough setup, but I would just end by saying we don't think this is the lost decade of the 1970s. Just returns are going to be a lot lower, and we're going to have to work really hard for our clients to find those opportunities.
With regards to the central bank put, you don't believe that the Fed, if markets, I guess, fell enough, would step in at some point to try to stabilize things?
I mean, that's obviously always a possibility if we go into a deep recession, which isn't our base case. Our base case is that the Fed's going to be focused on fighting inflation, growth is going to be moderating, returns therefore are going to be more scarce, and we're going to have to be looking across the markets for opportunities for clients in places like tech, for example. Climate transition are two areas that we're looking at really hard now.
Well, let's talk about tech, for example. I mean, we know that there's sort of kind of the short-term growth momentum tech names out there. There are also sort of structural names and structural sectors out there that reflect a lot of secular shifts in the economy here. Are you focused on those, and if so, where?
I think tech is down, obviously, but not out. That's my big headline around tech. And if you look at what's happened in the space, tech market's down 20% on average. The software part of the market's down 30 to 50%, depending on names. Why? Because for this sector, for the first time, is facing the facts, or first time in a long time, that capital actually costs something. Inflation is here. Eyeballs are going to TikTok. It's been a tough operating environment. I would just offset that by saying that ultimately, when you step into this sector, you're actually believing in something that's quite secular, not cyclical. And Satya Nadella said this really well on the Microsoft earnings last week. Someone was pushing him on this very point. How bad are these macro challenges? Can you operate through this? And he had this observation that I'm not so focused on that because when I look out 10 years, tech as a percentage of GDP is going to double. And we want a piece of that for our clients. So we're really trying to allocate them against that monster TAM, or total addressable market.
But break down tech into, I guess, something a little bit more bite-sized, because there are the Microsofts and Apples of the world with a ton of cash in their balance sheet, relatively low debt service, that one way or another are probably going to find a way to thrive. Then there's sort of these second-tier tech companies where I think there's still a question mark around their longer-term viability in a potentially lower economic environment.
I actually think if you can find in that middle category, so below the FANGs, if you will, but these emerging tech leaders that have the ability to get through this difficult operating environment, and you can access them at these valuations, that's where there's actually some really interesting opportunities in the US and around the world. And here's why I think that. I spend a lot of time talking to CEOs, so does my team. Goldman Sachs Asset Management, we meet with over 10,000 companies a year. I have yet to meet a CEO that's telling me they want to cut their enterprise spend. And I like to buy things that I know my CEOs are investing in. So I like digitalization of businesses. That's what we're invested in as a team. And you can find a lot of companies in small and mid-cap space, specifically take software. Robert Smith has a great quote on this, which is software is even better than first lien debt. Because if you depend on that software for running your business, you are paying that software fee before you even think about servicing your debt. And we can find a company like Qualtrics, which is in that space.
Right.
A lot of companies dependent on it, small cap, not well covered, compounding at a very high rate while the stock is off 50%. So there should be great opportunities here. Don't give up on growth.
Okay.
In a world where growth gets more scarce, it should re-rate.
It should re-rate, and it has re-rated. There's some concern it could re-rate further.
Yeah, well, in other words, it's obviously sold off a lot, but we would stick with growth here in portfolios selectively because it will recover and re-rate from these levels. That's our view. So we would not give up on growth in a world where actually it might be scarce. We would just have balance in the portfolio, own that, along, for example, some stuff in the commodities space because there is going to be heightened inflation.
Right.
And you want to own assets that can actually benefit from that too. So balance will also be key here.
One of the other big secular trends we've seen a lot is the move to renewable energy, alternative sources of fuel. Where do you look for opportunities there? Is there just sort of the traditional names, the Teslas of the world, maybe a couple of the oil companies that have made the transition, or do you look a little bit deeper?
We really do believe that we're on the precipice of a major revolution here in climate transition, and I want to be clear that we're allocated to that in two ways. We actually continue to own some of the traditional hydrocarbon companies, but we engage with them. So we don't believe in divestment, we believe in engagement, because 85% of the world's fuel is traditional hydrocarbons. So the path to sustainability actually runs through the oil patch, and we'd rather those assets.
But when you say engagement in your role, you're not necessarily talking activism in the traditional sense.
Yeah, it's a good clarification. We engage with companies to make sure that they're running those assets responsibly. Because if 85% of the world's fuel source is still traditional hydrocarbons, we believe that those are better run in the scrutiny of public markets. And we just work with those management teams to make sure that those assets are being run responsibly because we need a just transition. So we do that. And then we also are allocated to alternative energy. And probably our favorite space right now is actually in the materials and owning the green metals. Because this decarbonization move that's going to happen over the next decade is actually highly mineral intensive. Copper, for example, is something that we own across all of our portfolios, which is the base metal for electrification. So you've got good demand, and then I would say on the supply side, because of ESG concerns, you have inelastic supply growth. It's actually really hard to bring supply to the market in these minerals. So that's, for us, been a great area to focus on.
We only have about 30 seconds left here, but I do want to just get your quick thoughts here on the competition between public equity versus private investment and private equity. That's really kind of honed in your space, at least for clients looking for better sources of yield.
I think clients that are able to should access both private and public markets. At the moment now, particularly in some of the spaces we just talked about, tech in particular, a lot of the pain has already been discounted into public markets. And the reality is that you can access some of these great innovation opportunities and technological disruptions at a 50% discount to what they've just priced in private markets. I'm biased, I'm a public market investor, but I'd welcome people to look in that space.